20 years ago, a panel about regulation would be considered deadly dull. I think regulation has become singularly either the salvation or the most aggravating and destructive force in the American economy. So this year, the panel is quite a bit more interesting. So let's start with you, and you wanted to talk about why you're really eager to get some federal regulation going on, and what part of the financial system you're in.
Great, well thank you, and thank you for the invitation for the event today. So I guess just to talk about what we think at Circle, and you already heard the advertisement on Circle, and Jeremy did a good job of talking about what we do and where we are kind of in the fintech ecosystem. Before I talk about that, I just want to talk about how we got to this point. And the term fintech is a really general, loose term, but it's kind of came about as a convergence of events, right? So you look at what we had over the last 10 years or so, and leading up into the financial crisis, and what's happened with banks, and it's really a changing environment. And banks are under extreme pressure. I used to work for a bank, so I know, but it just, post-Dodd-Frank, it's gotten worse in terms of the regulations, the compliance, and to build a business, and to innovate, frankly. And you combine that with customers' needs, a new generation of millennials looking to utilize the internet, to leverage the internet, and looking for products and services, especially in the financial space, to be delivered a new way.
So I'm going to just break in, and because they've heard that, I mean, it's, with all deference, many times this morning. Mm-hmm. What do you do? Why does it benefit from national regulation? Why are you suffering today in the current environment?
Well, we have this process where a company like Circle, we have to go through 50 states to get licensed.
Because you do payments.
As a money transmitter. And to do so, it's an onerous process. I can tell you it took us maybe over 2 years to go through that process, and we have ongoing reporting requirements. Contrast that with, we're also licensed in Europe and with the FCA and as an e-money institution, and they have a dedicated group, Innovation Hub, which is dedicated towards fintech firms like us, innovative firms, working through the process, giving us the freedom to promote these new products and services, get licensed, and then passport that through Europe. And so it's a much more friendly environment. It's not only that, but they've also have a number of cooperatives and agreements with other nations such as Singapore and Australia, and it's just building that, what they call the fintech bridge, to further increase the ability to do business on a global basis. So when you're a fintech firm, you're trying to bring products quickly to the market, to have to converse, to go from a two-year process to this other process. That's one thing that's very helpful.
So it is very odd that a payment company is not regulated nationally, but there's a lot of history to this. And Mr. Curry could talk about it when we get to him. You'd think that the quintessential nationally regulated product would be something that transports money across state lines. But in fact, all finance in America was originally state regulated. And this is one that kind of escaped the purview. And it's only really come to the fore, what would you guys say, since the banking system has begun to be disaggregated. Since payment is being separated from the banks themselves, which would be something that would come under your remit, or a state banking thing that would have a holding act, that it's this breakdown. And I guess the state rule is kind of a default rule that has been caught in a weird kind of archaic legal limbo as you go into something else. Now the other question would be, should it be regulated at all? And so I think this will be an interesting, because you're in a payment company too. And who regulates, well, why don't you say what your company does, and who regulates you now?
Great, so name's Adam Ludwin, co-founder and CEO of Chain. Chain is, as the name suggests, a blockchain technology company. So in the same way that Oracle, SAP, Microsoft, the telecoms, as far as financial services regulations go, those are not financially regulated institutions. Nonetheless, the software that they build is, for all intents and purposes, the rock face, the rail that stores, transmits, and secures trillions and trillions of dollars of financial assets. But it is the infrastructure that is purchased, implemented, and operated by regulated, licensed, and financial institutions and financial services businesses. So Chain's customers are companies like NASDAQ, Visa, Citi, State Street, et cetera. They are all regulated through the patchwork quilt of regulatory bodies here and abroad. So Chain, and I think it makes sense for all technology layer companies, is not regulated per se. Nonetheless, in June, I did speak to Janet Yellen and the Board of Governors about this technology. Last week, I was at the New York Fed speaking to 60 central bankers and different regulatory bodies from around the world. And the reason for that is because regulators are thinking forward to how does what a bank is, how does what a clearing service is, how does that fundamentally change in a world where, as you've all heard from the last panel, cryptography gets applied to financial services? What do we have to anticipate and think about? So we are engaged with regulators. We spend a lot of time educating regulators. Nonetheless, our company is not regulated by a financial institution. I don't anticipate it ever will be.
So what's the problem with being regulated? We give here's a man who wants to be nationally regulated.
Yeah.
Why don't keep out all the scum? Keep out all the people who aren't quite as clever as you are.
Sure. So I think
confidence in the financial system.
Sorry.
By the way, you guys should be free to ask questions yourselves.
Yeah. Philosophically, we don't think of regulation as our strategy. And I think in general, as assets become digital, which is what's happening with what blockchain is enabling, when assets become digital, financial services becomes a software business. And in software businesses, you compete on two metrics, and neither of them is regulatory. The first is on network effects, and the second is on innovation. So if we can innovate and build network effects, we will win. We don't need to ossify that position with a regulatory framework. Nonetheless, I think, look, we're in financial services, and it's important, I think, for financial services to have a regulatory framework for the protection of individuals, businesses, for the whole all the systemic reasons that we know. So we're not anti-regulation, just it's what layer do you regulate, and it's probably not at the data layer or software layer.
So we went through this with the bit license process specifically. I mean, there was, do you regulate, how broad do you cast the net, and do you regulate software? And really, from the regulator's perspective, it's all about risk, right? It's about, and I know Comptroller Curry will talk about this, but it's about responsible innovation. It's about risk and controlling the risk. And when you're handling digital currency or Bitcoin or whatever, it's important you look at when the currency is going between the traditional financial services, there's a risk there, the on and off ramps. And if you're holding people's digital assets, if you're holding your custody of people's funds, those are risks. And so there should be general consumer protections. There should be general regulations around AML for those types of things.
I like the argument. We like regulation, just not us. Because we compete on innovation, and what was the second thing that you said? And network effects. I mean, doesn't everyone compete on innovation and network effects, and yet they're stuck with regulation anyway? I mean, what makes you that?
Just to be super clear, if Chain ever brought a network to market, I think we'd be fair game to say, okay, well, we should think about regulating that because you're now delivering a financial product to a customer. Chain is like Oracle, right? You don't regulate the database company, right? You regulate the company implementing the database to launch a product. So Chain, our partners are already regulated. And one of the reasons our strategy is to go to market through partners is they have the regulatory structures, licenses that give them the ability to actually bring these new products and services to market.
I like this idea of regulation as a strategy, too, because that could be, but it's also kind of perverse in its sense if you hear it, because it suggests that your real expertise is dealing with government.
Well, there's an argument that is the way a lot of things work.
Yeah, exactly. So you have thought a lot about this, Mr. Curry, and you've actually gone to the step. You've probably heard, if you could both lay out the different thoughts that are going on here, and because you really encapsulate what both of these people have said.
I think what we're really talking about is what's the nature of banking, and then what's the role of technology in banking.
And what's the role of,
and
you?
Yeah, and as the regulator, I would submit that banking is technology and always has been. Its basic core is safekeeping of cash and valuables. So how you manage that record keeping, whether it's with a stylus and a tablet to blockchain technology, that's a part of banking. So from the OCC's standpoint, and John mentioned this, we're looking at it as this is part of the business of banking that we regulate. So how do you rethink the regulatory structures that you have and your mission to create an environment where you create a responsible lending environment where you have safety and soundness considerations, which I think when you're talking about other people's money and the implications for financial stability, safety and soundness is valuable to everybody in this case. And then how do you protect if you're dealing in a consumer-related transaction? What's the appropriate level of consumer protection? And what's the role of, as again, we regulate banks, what's their role in the community and to bring people into the financial system, which is widely recognized as a societal benefit. So what we've done, this goes back to August of 2015, look at it outside, try to get outside of our traditional brick and mortar approach to regulation, and how do our existing structures work, whether it's statutory or not, and then how do we supervise, which is really the art of what we do, to the extent there is an art, make judgments about risk management systems, appropriate levels of capital, management's capabilities to deal with the pitfalls of a banking business. So we came up with a outline of our approach to responsible lending. There's 8 specific principles that we're going to be guided by. We went out for comment. One of the things that we are going to be doing, and which I think is essential, and kind of what's going on in this panel, is the need to provide clarity as to what is the role of the regulator in the fintech area, and to provide clarity to both fintech firms and the institutions we regulate directly. You need technology. How do you go about either procuring it? How do you go about strategic partnerships? And would you, under what circumstances would you allow a direct entrance into banking? I think there's a need to lay out in a clear fashion what those criteria are. To keep it in the shadows or to make it a mysterious type of operation doesn't do anybody any good. And you run a risk of people exploiting backdoor approaches into banking without the benefit of trying to think of what's the best way to approach this issue.
So could you talk about your principles, and can you also talk about the comments that you've, both negative, I mean, I'm very interested in exploring both the negative comments and I assume there are a lot of positive ones too, but this is a very fraught step. I mean, if you think of how you've gotten from 1863 to here, there are a lot of lily pads that you've left over.
There's a lot of similarities, which I think people overlook.
Yeah, so
part of the reason for the creation of the Office of the Comptroller of the Currency was to finance the Civil War. But President Lincoln also had the goal of creating a national platform for banking and as a method of weaving the country together. So it's kind of in the context of what John was mentioning, it's, do you want as a society and as an economy to have a single national platform to conduct economic activity, whether it's payments or lending or whatever attribute of banking you're talking about. So that's something that's part of our DNA as an agency. There are built-in advantages, certain elements of federal preemption that remain from Dodd-Frank would, in John's case, eliminate state licensing requirements. But it also raises issues of, we have the ability to impose prudential conditions. So what would be the appropriate level of conditions that you would impose on that type of entity if it was directly regulated as a bank?
So can we get granular with the this blueprint is going to be discussed a lot. It's going to be debated. I'm interested, I'd like you to discuss it, but I'd like also you to say what you think will survive, what might come under most attack, what people say would be most oppressive to the system, and what is really a slam dunk. This will go through.
We have 2 goals. One of the things that we emphasize, and John mentioned this, is really having the appropriate risk management controls in place. And we have really one concept that is especially relevant to fintech firms seeking to partner or to have relationships with banks, and it's really third-party management guidance. We've laid out what I think is the state of the art in terms of the regulatory requirements and frameworks for banks to engage with others. Our basic principle is that if a bank engages with a third party, they are responsible for that third party's activities. So basically, we're looking for the appropriate level of due diligence and monitoring of those activities because at the end of the day, it is a bank that's providing those services, whether it's directly or indirectly. In the context of the potential of having a bank charter, whether it's a full-service FDIC-insured institution or a limited-purpose institution. We need to make sure that the basics are in place. What is the appropriate level of capital to support that business model? What types of where if we were talking about a limited-purpose bank, there's some gaps potentially, which may be more or less important depending on who the fintech firm is dealing with. If you're a consumer, I think there's a greater sensitivity to make sure that there's an appropriate level of consumer protection and that there's not an opportunity for regulatory arbitrage through the national bank system.
Do you have any sense that that's going on?
What we're doing from a process standpoint, a couple of things. In terms of providing a clearinghouse or a safe place to talk about regulatory requirements, we will be issuing a paper which will outline our regulatory structure. We will be creating an office where in a non-regulatory environment or non-supervisory environment that fintech firms can tap into the resources and knowledge that the OCC possesses to answer those questions. So if you're a fintech firm, I want to do a partnership with a regulated bank, what do they need to know about me so I can plan to in advance to deal with those requirements? And that'll happen in the next few weeks. We'll lay that out and open up the structure as organizationally. From a chartering standpoint, I think where we are, we will be issuing another document in the near future, which will outline the basic legal issues of under what circumstances a fintech firm could obtain a national bank charter, a limited purpose one. I think the initial legal question is answered in the affirmative, but that yes creates additional questions, whether it's additional legal issues and also the questions of what's the appropriate level or tailoring of traditional bank regulation to these entities.
I just want to bring limited purpose charter just as there are three words that could make many people think of checking their email. So I just, if you could break that down.
It's an important concept.
Yes, why people care about it so much.
The banks today, retail banks today, all have deposit insurance. All right. I am a chartering authority. I can issue a full-service charter to appropriate applicants. They must then go out and get a separate approval to get federal deposit insurance from the FDIC. Those processes may not be in sync at this time. So what we've been exploring is to what extent legally is it permissible to not have federal deposit insurance and which may or may not present opportunities for fintech firms, but that what I was explaining, that also raises additional questions. All right, do you have gaps that, from a prudential standpoint, we would need to fill in our approval
So let me
process?
just give you guys some kind of, because I guess Mr. Curry is correct. He can't identify people who might be interested or not, or it might be a compromise. So I will. SoFi, which does the refinancing of student loans, has talked about trying to get a bank charter without deposit insurance to enhance their operations. I don't really understand why you would, and when I say I don't understand why you want one, I'm not arguing with why they want one. They've thought about it. The guy who runs it is a lawyer. He's thinking that there are real advantages having a federal bank charter without deposit insurance, but they're not innately obvious, intuitively obvious to me. So why, both of you.
I'll give you another example why.
Go ahead.
So today there are two people. So my net worth right now is spread across two different companies. One is my bank, has a very heavy-duty charter, and the other is Levi Strauss. In my pocket, I have money that Levi Strauss is custodying for me, and it's $11 right here. Okay, this is not sitting in some legally regulated institution. The gap between Levi Strauss and Citibank is too big, and there is an influx of new, innovative ways of thinking about custodying assets, and there's a whole new set of assets coming online that are emerging from this blockchain kind of wave of innovation that are not only introducing new forms of assets, but digitizing existing financial instruments, and we can control those instruments cryptographically in a way that's much lighter and just as secure as traditional database architecture. So the innovation that the OCC is driving is going to essentially bridge that gap that is today, I think, keeping a huge degree of opportunity out of.
I just want to be clear about or what you're saying, though. Let's say I created an institution, I got a federal charter, I didn't have deposits. You want that if you're an institution because it would give customers some reassurance that you're inspected, that you want that.
Yeah, and again, I'm not going to comment on a particular.
Yeah, of course not. You can't do that. Yeah.
Yeah, and ultimately, it's the people in the audience who are going to decide whether here.
But it's the appeal.
But a couple of things are going on. It really depends whether you're in the payment space or whether you're in the consumer credit space. So we'll start with the consumer credit space. What you have to remember is that the laws in the United States are structured around your role as a creditor or not. All right, so there is regulation today at the federal level and at the state level for creditors, consumer credit grantors. So you've got the CFPB as a federal regulator, and you've got state licensing, small loans or whatever law structure that would apply. The advantage to a bank would be the ability to have a national platform. Yeah. The advantage of being FDIC insured is that you have a stable source of funding that's not volatile. You could not have deposit insurance, but then you now have a volatile funding base, and whether this is a benefit or not, an advantage I think of a bank regulatory agency. We're very experienced in terms of credit cycles and credit underwriting and other and models along those lines. So there's a potential benefit to the institution to being licensed and regulated as a bank. Now, if you're going to take out deposit insurance, you're actually you're going to be relying on really short-term, more volatile funding sources. That would be a negative in terms of the viability of that business model as a national bank. So anyone who is considering that needs to address the stability of your funding as part of your business plan. But again, I want to mention, double back for one thing, we are analyzing these issues about chartering. We are going to come out with an additional white paper where and I think this is incredibly valuable to us and to you, we need to get additional input on and direction on our approach that we'll be putting out as a draft document.
It also comes down to activities and what you can do and your reliance on banks. So there's, over 6,000 depository institutions in the US, and only a handful of them right now would work with companies like ours that deal with the blockchain in any fashion, okay? So, and to facilitate our transactions on our platform, we need banks, we need banking partners, and that's costly and it creates friction in the process. And through something like the limited purpose charter, that could strip it out. That could give us more ability to do things in a seamless way and take it out of and not having to rely on the third-party banks. And you're seeing that already overseas with Bank of England has introduced and talked about allowing non-banks such as ours to have access to settlement accounts and central bank funds. And so things like that are other benefits to the charter.
So I can see why a company, the idea of having a chartered bank without a deposit component is a very interesting concept. You want the regulatory stamp of approval, but in a sense, doesn't that create a huge regulatory expansion of what the OCC must do, because you now have to look at these other entities and create a kind of moral hazard, because all of a sudden you've delegated the market decision that the bank would have had to make before on these third parties, and you've placed it in a regulatory entity. And therefore they don't have to be quite as discriminating in the decisions that they make when they make I mean, these are just things that I know you're thinking about. So
first off, I think it's important to note that there is a historical precedent for limited purpose banks. Non-federally insured trust companies are limited purpose national banks. You also have a tradition of credit card banks, same thing. So there's a level of regulatory experience with that type of charter in different contexts. The issue is really going to be, what's different about the business that you're in, and what's the tailoring, the appropriate level of tailoring, and what's the appropriate level of prudential. This is all discretionary. You don't just come in and plop your money down in an application and get a bank. So what are the things that we would want up front to make sure that this is a success? We charter banks in perpetuity. We also need to be able to address potential failures, and that's one of the other elements of this. Because you would not be federally insured, we need to make sure we have the mechanisms to wind down any institution, and that gets back into the capital. What's the appropriate level of capital that you need, and how administratively would you wind down an entity?
Let me look to the audience. Are there any questions, particularly if you have any libertarians out there who would like to attack the controller of the currency? This may be your only opportunity. In fact, if you agree to do it, I won't ask your background or any other identifying thing, except for your phone might be on. And
I'd ask John. I think it's a crime to assault a federal official.
Are there any? Yes, there's a question over here. That's terrific. Thank you. Are there others? Raise your hand so I know where to go to you, even though we have someone speaking right now.
Just in terms of payments, do you think it's in the public interest for consumer-to-business payments and consumer-to-consumer payments to be able to occur without any fees?
Without any fees, did you say?
Correct.
Low-cost products is something would be a public advantage.
And I just one thing on that, which is going back to the limited license idea. Since you can't give examples and you shouldn't, I'll give one. How many people would consider keeping $50 in your Gmail account, so you could just email friends money? In other words, if Google could hold, I'm getting hands. I'm not even really asking. Yeah, a lot of people, I think. So in other words, financial services traditionally the banks are not innovating at the pace of the companies that are now driving so much innovation. Financial services is not really, doesn't bend to our will. We bend to it. Yet everything else around us, whether it's Uber, our communication, the way we get video on demand, it all bends to us. So the companies that are best at providing those services, if we could provide a regulatory structure for them, I think it's a really exciting opportunity to think about. So that's one tangible example that I always come back to, and I think would drive down the cost, especially of very small payments. And fintech like Venmo and these other services, they sit on top of the existing structure. They're just thin layers on top of, eventually you get down to a big regulated bank. So what we're doing, what's happening here is you're starting to allow for more innovation, I think, and I think that's very exciting and will drive the sort of things that you're talking about.
I just want to add a historical comment on non-insured products. Deposit insurance has only been around since 1933. But prior to 1933, you did have runs. When people think they're going to lose money, there usually is a panic. So I think today we have to think about people's willingness to take on risk is an abstract. What happens when people actually lose money in other mediums? That's, I think, the real test for fintech, and whether or not a level of regulation is a benefit or not.
And I think the market, too, will drive a lot of this. I mean, you look at, we're not regulated as a bank, but our customers do have the benefit of FDIC insurance. We hold our customer funds with a depository institution, and they have that pass-through insurance. Now, companies like PayPal do not do that. And so, there's a lot of questions there in terms of what's the risk, not only to the customers, to the financial stability as well, if you have a number of these large fintech firms doing so.
I guess, unfortunately, Mr. Curry you can't address the PayPal exception, can you? Because it's too sensitive. If you could, it would be a very interesting thing to think about, because it does sit outside of the framework. And any thoughts that you want to share with?
No, I think
we can always try. It's all off the record.
Yeah. Is that why I signed the release?
Yeah.
No, I think that's the issue. There is, to what extent does a particular practice result to or have a systemic impact? I mean, we do have a mechanism under Dodd-Frank for non-bank firms to receive a systemically important designation.
So yeah, it's interesting. It's been used in a very limited form, and actually, it's actually had to pull back for that. Other questions out there? Yeah. Oh, this is great. I really encourage you guys to be part of this conversation. So there are two right over here. There's a woman right there. Can we get a microphone? And then there's a second one. Who was the second? Yes. So it'll be you and then you. Thank you very much.
During the last panel, they spoke about more kind of freedom of flow of currencies or through the blockchain. Some of the unintended consequences of Dodd-Frank and Volcker sort of restricted capital. So is there a way to, I don't know, loosen up some of the, without actually changing the laws to facilitate some of that restriction that was incurred from the regulation? If that makes sense.
I don't know if I'm answering the question correctly, but I think to the extent that the blockchain technology reduces the operational risk of banking or an aspect of banking, that would, in theory, be a factor in terms of what the regulatory charges are for a bank to reserve against for operational risk. So, I mean, from our standpoint as a regulator, I think that blockchain technology has a great potential that actually is an advantage to the banks that I supervise. And if it reduces the cost, reduces the opportunity for operational risk, and allows for regulatory oversight, which would be one of our considerations to monitor the system, that's a positive.
Can I rephrase it, or maybe provide an example? So let's say in the high yield market, because the banks can't hold as much inventory, the markets aren't as liquid as before. And you guys were talking about earlier about providing, alternate marketplaces, essentially, through Bitcoin and so forth. So that's where I was sort of thinking, bridging the gap now, where you could actually provide more liquidity through this alternative, because you don't need to have the balance sheets of the bank necessarily for the marketplace.
No, I mean, I think prompt settlement, that reduces a lot of the risk in the system. And if you have a reliable, quick method of settlement, that's a plus to the system and to stability. It's really when you're concerned about your counterparties is when all the trouble starts and things start unraveling.
There was another question from and there's one over here. Oh, yeah, we will definitely get to you. So there's a question here. Where was it? Yeah, thank you. And then we're going to go over here if you don't mind.
My question around how do you bring regulation that is holistic and equitable? When I look at the banks, they have been really dealing with a lot of additional regulation that came about in the last 5-6 years. And you're looking at this shadow banking and fintech companies where maybe they don't have deposits, but they are impacting the society. Banks are buying their loans. They're issuing securitizations that are bought by asset managers who hold people's retirement money. And when you look at these companies, their framework, how they're organized, they are not sophisticated in terms of regulation because they haven't had to deal with it. And yet banks are not really able to keep up with them because they have to deal with it.
You must be so happy to answer this question.
No, I mean,
do you have an answer for that? Does it
Yeah,
have
I
8
actually
points
do.
to it? And
Yeah,
which
we'll
ones
see.
would you like?
We'll see if it works, right? No, I mean, I think the concept behind the level of regulation since the global financial crisis is to reduce the risk to the financial system, particularly those entities that are regulated. So what I'm getting at is the institutions that are subject to Dodd-Frank are the ones that have the benefits of the federal safety net, whether it's federal deposit insurance, access to the discount window. That's the exposure of the United States. So what Dodd-Frank is trying to do in concept is to reduce the risk to the system and to the United States as a potentially ultimate backstop. So you're absolutely right that when certain requirements are imposed on regulated entities, it's like water, it may move off somewhere else. I think the structural approach under Dodd-Frank is if that movement into the shadow banking system is significant enough, the framework of the Financial Stability Oversight Council's designation process would bring them in to the same level of prudential regulation that a bank or a bank holding company has.
Let me take the flip side of her statement and say, to what extent has the flexibility that has been shown by all these new entities that has arisen, to what extent has that benefited the U.S. economy by creating credit where otherwise you wouldn't have gotten, and I mean useful, focused, disciplined credit to people who could use it that would not have gotten it because the banking system itself has become consumed with regulatory, maybe overreach? And to what extent are you therefore concerned that your new efforts to bring all those things under the regulatory system will actually repress the kind of vital well, what were we saying about it?
I mean, I think there's always an obligation to recalibrate at appropriate junctures. So yes, we as a regulatory community need to look at what we've enacted, how does it work individually, and how does it work as a whole. Going back to the benefit, I think we should not ignore the benefits of financial regulation since Dodd-Frank. I mean, we have a banking system that has considerably more capital, considerably more liquidity, and it's much stronger than it was going into the crisis. The problem in an economic crisis, if you have a weak banking industry, you have a drag on economic growth. So the concept—
I think the question was particularly, are you worried that you will, by putting more regulation into the fintech space and in the innovative things that this woman has so articulately raised, that you will repress that sort of development, and that will be?
Again, I mean, this is a choice, not a mandate, or at least not a mandate explicitly by Congress today. Whether if that happens, that non-bank firms, fintech firms must have a federal regulator or a prudential regulator, that would be a valid consideration. But right now, in this context, it's really an issue of do you qualify for a bank charter, and
do you want it?
Yeah,
right.
Do you want it?
Can we take this question right here?
Tom, I was going to take you up on the libertarian opening.
Wait a second.
Great.
This was my, okay, we have two questions. We have you and then we have you, and I really want both, so
Okay.
please.
So, I mean, I guess when you look north of the Atlantic, the neobanks, there have been, I think in the last couple of years, at least half a dozen neobanks that have received banking licenses. And when I look here stateside, it's not clear that the word neobank is even a known term. In the post-Brexit world, would just like you to opine on what that what that shows us in terms of opportunity on being more expeditious with regulation and just overall global competitiveness in the way we look at neobanks.
So help me, is your question, have we repressed innovation in banking or the desire to be in the banking? What is your
chartering, new charters?
That's correct.
Yeah,
New
okay.
banking charters.
And can we get the mic over there for the next question? Too? Yeah.
No, I think a couple of things are going on there. Usually, in past cycles, once you emerge from an economic downturn, there's usually new charter activity occurs. I think that this period's a little different. We had a massive number of failed and weakened financial institutions. So from a pragmatic standpoint, it was actually easier to buy a failing or failed institution that had an infrastructure in place rather than investing on a startup from the ground up. So I think that repressed some of the new de novo chartering activity. Also, I think the environment we're in, banks operate on margins that are really compressed. There's a disadvantage to doing it. There's also an element, I think, of, again, this bank charter is not like a business corporation that you go to the state secretary, you fill out a piece of paper and do a filing fee. It is a discretionary act of the chartering and deposit insurance firms. From the OCC standpoint, we are open for business if you have a sound business plan, adequate capital, experienced management, then you essentially have met our basic test.
And the OCC just updated their licensing
That's
booklet,
right.
so check that out.
Thank you. So this is ultimately a question for the controller around if there is an outreach attempt to educate the fintech firms around what the supervision and enforcement regime would look like if they chose to become banks. And what's behind this question is, I'm one of the 6,000 banks that you guys regularly call to see if we can be the last mile to settle the payments or to be the custodian. And the reason we usually demur politely is because we're not sure that what you guys do, virtuous as may be, would stand the kind of rigorous examination procedures we go through. So we are frightened to death of the fact that because a lot of what you guys do at the surface, at the KYC level, is fine. It's finding out what people's names are and where the companies are. But if you look at the AML and BSA regimes and the OFAC regimes that we have to follow, it goes a lot deeper into CDD and EDD. These are terms that other people may not know, but if you're a payments company, you have to live with these. It requires a lot of subjective investigation, and we're not sure, technology or otherwise, whether you guys can do that. So the connection back to the question to the controller is, I wonder if these guys know what they're getting into and they sign up to be a bank.
All right, that's, again, the approach I outlined. We do think there's a real need and a value for having people come in and know what the rules of the road are. One of the things that I hope is apparent to people, whether you're a marketplace lender or in the payment space, a lot of the rules apply to you already. You may not know it, but they apply to you. So if you're talking about the advantages of partnership between a fintech firm and a bank, one of the advantages of a bank is they have an expertise in regulation. And what we're talking about today is not a blank slate. It's really an existing structure that we're trying to make adaptive to the changes in technology.
And Tom, I think I can answer the question you had about PayPal. PayPal at the very start put in the, how is PayPal doing it without being a bank, is that they started at the very beginning with people who were FinCEN certified. FinCEN is the agency that looks at monitoring financial transactions and money laundering. And the companies that they have bought all have FinCEN certified people in it. So they've baked it in from the start.
It is interesting that you have such an important company, though, that is outside of the net. And there are a lot of other companies that are vaguely outside of the net, and whether they come in or not. What are the objections, if any, to your template have there been? And how have you responded? And how do you think you might modify it in the future based on what you've heard?
I mean, I think the overall approach we have is we want to be transparent. One, I think we recognize this as an issue and we want to get input. And we've done informal outreach trying to educate ourselves as well. But this will be something that we will put out for comment. I think that's valuable. Is the underlying approach right or is it wrong? We're going to have some questions we want answered. Getting feedback from people in the field, whether they're bankers or fintech firms, is very valuable. And then at the end of the day, it's going to be, and I want to make this clear, it is a discretionary decision as to whether someone gets a bank or not.
Before we came on stage, Mr. Curry was very apt in describing the world that he operates in as spaghetti or something like that. That there are innumerable regulators and innumerable parts to this sort of stuff. And do you have any confidence that if you say to a fintech firm this is okay, that the myriad other aspects of the regulatory apparatus would?
Yeah. In our white paper that we put out, this is one of the things that we think is an area where we have an obligation to address, which is to encourage and develop collaboration among the many regulatory agencies. Again, going back to the example of a marketplace lender, we think we have an obligation to work with the Consumer Financial Protection Bureau so that we're not at this cross purposes. So that requires an affirmative approach by both the OCC and the CFPB. But I think there's a recognition that we have to go that way. When you talk about payments, we have to work with the Fed. I mean, they're really the guardian of the payment systems. So it's really looking at, even though we have separate statutory mandates, how do we all work together to have a cohesive financial regulatory system that works for the economy and the American people?
So I can understand why you have an obligation to do so, but nonetheless, there's been 150 years of the OCC, and there's been since 1913, whatever it is, for the Fed, and there are the New York State regulators, and from my understanding, nobody really sees things eye to eye, even after all that time trying to work things out. And banks are always complaining in New York that they can't, that there are conflicting regulations of all the different entities. And even, I guess I'm going back to your statement that you have an obligation. I think most people would say, well, that's fine. We're glad you feel that there's an obligation. But in reality, what are the chances that actually you get all these groups to collaborate on your standards? Is there any?
I've been a state and federal regulator for over 30 years. That's the way I've operated, and that's the way I'm operating as the comptroller.
And so you think it's feasible that you could have?
Somebody has to start, and that's really what we're doing.
As an outsider view, I'd agree too. I've met with every one of the agencies, and everyone has a working group on this. And I think in the post-Dodd-Frank world, there's been so much more collaboration among them. They need to because of the system.
How do the states feel about giving up authority on some things? I mean, I'm sure they're collaborating, as you said, but do they feel good about that?
They're collaborating, but obviously it's a territorial thing, and I think at some point, there is pushback. I think some of the challenges to what the OCC is doing is both at the state level and at the banks as well. The banks want to know, is there going to be a level playing field? How is this going to work? And these are all questions that need to be answered for sure.
Let me just say, we only have a minute left. Let me see if there's one more question out there. Is there? I just want to make sure we've handled everything. I am not seeing any hands. If there is one, stretch further. Okay. Well, let me just ask you, if we were to come back on this panel in 18 months, well, I don't know what the time frame is. When I go and talk to fintech terms, if you come back in a year and they're still alive, it means good things are happening. But there's also a very good chance that they're not alive as well. I mean, the life cycle can be quick. With what you're trying to do, what is your time frame for showing meaningful change? Should you be back on this panel next year, or should it be in 2022? Or
I'd answer it a little differently. I think it's ongoing. I think there's two parallel courses of action. One is, how do you appropriately incorporate fintech firms into the chartering process? What's the framework the ideal framework? And then the other is, technology's here. Banks have to confront it. We need to make sure that there's from our standpoint as a regulator, that there's an understanding of what the prudential risk management concerns are that I think ultimately will benefit both the banks we regulate and the fintech firms that choose to partner or to have relationships with national banks or federal thrifts.
So do you think you'll have something worked out within a year? Or do you
we will have, as I said,
you have a comment period that's...
Two things. We are going to have, in the short term, within a few weeks, an office that banks and fintech firms can come in to talk about the issues we've talked about today, get some guidance, not in a regulatory context, but to be able to figure out where they're going to be strategically or where they're going to be in relationships with other firms. The separate issue really is whether a fintech firm standalone would be able to obtain a banking license from the OCC, and what are the prudential and other considerations that we think a firm should have. Our goal would be to have that really set out so that people can make an analysis of whether or not they meet our standards and whether it fits their business objectives.
And that would be in the next 2 years or 3 years?
Well, I think we want to articulate what we think the chartering framework should be in the short term. I can't guarantee when and if it's going to be something that would work for the vision that a fintech firm has and what our legal and mission obligations are.
And I'm sorry to press you, but this is the one area of Washington that's really, I think, making the greatest effort to really work with fintech. And it's bringing an area of business that seems to evolve and devolve, in weeks and months. And I know you're going faster than any other entity in Washington could ever really operate. I think you're really the most interested of all the regulators in Washington. So when I push you for your time frame, it's not because I think in fact, you're as fast as they get. You are the Casella of Washington, but the question is,
Not bad
how
for
fast
being
is that?
153 years old, right?
So,
But pretty
right.
good.